So yes, let's get started. So good afternoon and good evening, everyone. On behalf of the UN Capital Development Fund, UNCDF, I'm very pleased to welcome you all to this side event on the margins of the FFD Forum, which will focus on building the financing architecture for the full spectrum of SDG investment opportunities in the LDCs. My name is Casper Sonesson, and I am a policy advisor at UNCDF. Allow me just to give a few brief introduction before handing over to the moderator. So at UNCDF, we offer what we call last mile finance models that contribute to unlock public and private resources to support local economic development and achieve the SDGs in the least developed countries. As we are well aware, LDCs typically face significant challenges in mobilizing the financing needed to achieve the SDGs, including especially private financing. According to our recent publication on blended finance in the LDCs, which we produced together with the OECD, between 2012 and 2018, only 6% of all private finance mobilized through blended finance approaches went to the LDCs. And even that 6% was highly concentrated in just a very small number of sectors, countries, and transactions. As a result of COVID-19, we've also seen further significant drops in overall private capital flows to the LDCs, including foreign direct investments, although FDI flows to LDCs have been, in fact, declining for the past 5 years. The financing gap is especially significant for small and medium-sized enterprises, as well as for smaller and medium-sized infrastructure projects in the LDCs. So as we now see a significant increase in extreme poverty levels in LDCs due to COVID, there is an urgent need to take a more systemic look at what needs to be done to increase access to investment capital that can allow LDCs to recover and build back better. So the objective of this session is therefore to explore how a more comprehensive and integrated suite of financing and de-risking resources and instruments can be made available to help fill financing gaps and unlock more investments across the full investment continuum. So before I introduce our esteemed moderator, just 2 logistics points for everyone. We do have interpretation to French. So for this, please click the interpretation button at the bottom of your Zoom screen. And for this Q&A segment, please post your questions in the Zoom chat box, and we will attempt to respond to as many questions as possible. So now to moderate this session and to provide some further introductory remarks, I am very pleased to introduce Susanna Moorehead, who is the elected chair of the OECD Development Assistance Committee since 2019. Susanna has a long career in diplomacy and international development, including as British ambassador to Ethiopia and Djibouti, and as UK permanent representative to the African Union and the UN Economic Commission for Africa. Among many other things, she also served as the UK's executive director on the board of the World Bank and as director for West and Southern Africa at the UK Department of International Development. It's a real pleasure and honor to have you here, Susanna, and now over to you.
Casper, thank you very much, and Preeti and all colleagues at UNCDF. Thank you for having me. Thank you for this this opportunity on a sunny Paris evening. We are living under curfew here from 7 in the evening, so it's very nice to have an opportunity to talk to colleagues late in the day. I mean, this session has a very long and interesting title. If I've understood it rightly, I think the exam question for all of us is how can we improve the amount of concessional and non-concessional finance going into the poorest countries in order to help them deliver the Sustainable Development Goals. And if I have one ask of the panelists this evening, it's to think out of the box, to innovate, take risks. This is a safe space, and we want to hear some new ideas. We want to really test and challenge each other. I think we know the scale of the problem. We often said before this terrible COVID pandemic that the SDGs, we were off track. I think we can now sadly agree that we're in reverse. And the least developed countries are, of course, the places where the suffering, the vulnerability, the deprivation, the poverty, the inequalities are the worst in the whole world. There is some good news. You may know at the OECD DAC, we launched last year's official development assistance figures earlier this week. And the ODA figure is actually higher in 2020 than in 2019. And there was a small but important increase in the percentage going to the least developed countries. That is good news, because some of the gloom and doom mongers were saying that ODA would collapse this year. It certainly hasn't done that. I think the less good news is we've still got a very long way to go. And we know that many donors did everything in their power to get as much resource into the system for 2020, and that inevitably will have put pressure on outer years. So what better moment to put our heads together to think about how we can get other sources of finance into the least developed countries. They are, as we know, more dependent than others on ODA, but we also know that official development assistance was never going to be enough. It's a fantastically precious catalytic resource, but we are going to need the private sector and other sources of finance to come in alongside. I mean, as Casper said, this idea of blending finance. So, people describe it in all kinds of different ways. I see it, frankly, as buying down some of the risk of helping that precious capital reach the parts that it wouldn't otherwise do. It is working extremely well in some countries, but the least developed country markets remain incredibly challenging. And I hope one of the things we'll talk about this evening is what can we do together to make it less difficult for this capital to go into these markets? What do investors need from the international development community, from governments, from the diplomatic community, from the financial institutions in the development space to make these markets more attractive? I think it's fair to say that the challenges to attracting private finance are going to probably get worse before they get better. Let's be honest about that. But I also think there is a massive opportunity now to really put some flesh on what has become a bit of a cliche, I'm afraid, to build forward better. But many of our political leaders are getting around different tables to try and do a better job of this recovery than we would otherwise do. So we are a small part of that conversation tonight. And as I say, I urge you to be bold, to innovate, to take risks, and to really push this agenda forward. So the way this conversation has been set up is I'm going to introduce my esteemed panelists as we go in the interest of time. I hope we can have 2 rounds of questions and then a sort of quick fire at the end to see where we've got to. And then, as Casper said, we will open it up for questions from the audience, time permitting. So that there's a premium on everybody sticking to the time allocated. For our first round of questions, I would ask you to limit your remarks to 5 minutes. And then we'll see how we go when we get about halfway through. So I think, without further ado, it's an enormous privilege and pleasure to welcome Minister Kruskala Banda, the Minister of Industry in Malawi. I have visited Malawi many times. It is a beautiful and extraordinary part of the world, but you have many challenges. And I think we're all very keen to hear, how has COVID affected the financial flows to Malawi and other least developed countries? And critically, what have you as a government minister been able to do to respond to that increased risk? And I guess, I mean, I know that small and medium enterprises are absolutely critical, not only to economic growth, but also to employment creation that is so important. And I wonder how you've managed to support them during this very, very difficult period. But Minister, you have the floor. It is fantastic to hear directly from somebody who is spending, I imagine, 7 days a week wrestling with this problem. Very warm welcome.
Thank you very much for giving me the floor and also for inviting me to be a panelist tonight. Greetings from Malawi. So in response to the question that has been posed to me, first of all, about the COVID, the money coming into Malawi, what impact has COVID had on that? To begin with, I think the biggest problems that we have to attract capital flows into Malawi is the issue of risk as well as a scale. Because most of the investors, I imagine, would want to invest money that cannot be absorbed by Malawian SMEs. On top of that, the people who would want to invest in the country are not sure whether they are going to get the investment back in terms of because of credit risk or currency risk and so on and so forth. So nobody could have predicted what COVID could have done, and that just added on the level of risk for flows coming into Malawi and other LDCs. No, as such, as government, we decided to take some specific measures to counter that. And the first one that we have put in place is what we're calling the National Economic Empowerment Fund. This is money that was approved by Parliament within the Malawi budget, so that it can be used to be channeled to especially youth, so that they can start up their own small and medium enterprises. In that way, we hoped that it would alleviate the problems they are facing to acquire funds from the mainstream banks, the high street banks, as we call them. So the National Economic Empowerment Fund will be targeted to the youth of all districts in the country. But we hoped that with training, we're going to be able to create micro businesses that are going to be able to employ the entrepreneur himself and maybe one or two other people, and thereby creating employment. Secondly, we looked at how we can de-risk investments going into Malawi. And one of the things that we found that worked well is the formation of cooperatives. And the reason we're saying this is because of the peer pressure that happens when people are not repaying. So it's a mechanism that is self-policing and that financial institutions can rely on. Because if you have one person and that person defaults, it's very difficult to get back that money. But if it's a group of people, the peer pressure on one another makes it easier for people to collect the money back. Thirdly, we have had agreements with World Bank, who have established a fund that is called Financial Inclusion and Entrepreneurship Scaling, which is money that's going to be provided by the World Bank through Malawian banks. Now, the good thing about this program is that because Malawian interest rates are very high, the agreement is that this fund is going to be driven through Malawian banks, but with less interest rates and also less stringent measures for people to get the loans. And finally, on the part of the banks themselves, because of the way the economy is, the people of Malawi have come up with their own innovative financial instruments. Some of them, what we call banking konde, but I know in other countries they're called village banks. And those village banks are instruments that especially women of this country are using to borrow, to lend money to one another and to repay. And so the banks have seen that as being a more secure way of lending money to women and the youth. And so we have seen that several banks in Malawi have started to use that kind of banking instrument to sort of make it, to regularize it into the banking system so that they're able to lend to women with less risk. So in a nutshell, that's what we have done as a country. Thank you.
Well, thank you, Minister. It was a very clear nutshell indeed. So much appreciated. I mean, I think we're going to come back to this question of risk. Look, we've all had to live with and manage unprecedented levels of risk during this COVID pandemic. So I think the challenge, for those of us trying to get more investment into the poorest countries in the world is to rethink our risk appetite in the way we've had to in every market. We shouldn't still have this static concept of risk in least developed countries. I think your point about scale is critical. I mean, there are so many countries that I've worked in where you cannot get the right size chunk of capital. It's either the very, very tiny microcredit or it's huge. So there's something about bite-sized chunks of capital. And I think when we turn to our private sector colleagues, it would be really interesting to hear from them how you can break up some of this lumpiness. Access to credit, it's some really interesting innovations there, and how do you deal with the lack of collateral? Well, you pool your risk. That's one way of doing it. And certainly in South Asia, this was transformative if it can work. There's then a problem about how you go to the next scale, but it's a really interesting start. And thank you for mentioning youth and women, because these are going to be the drivers of entrepreneurship. So great start to our conversation. Let me turn now to Preeti Sinha, the Executive Secretary of UNCDF. Preeti, thank you for organizing this and inviting us all. Look, tell us what you think the problem is and the gap in the architecture, but I think also much more, what can we do about it? To be honest, I think we know what the gap is. I'm sure you can tell us very clearly, but I'd really like you to spend most of your comments on good ideas to try and bridge that gap. You have the floor.
Thank you, Susanna, and thank you, Minister, as well, for your comments. I'd like to take a two-pronged approach. For this issue, it's always the demand and the supply. So the pipeline and the resource mobilization, right? For me, there are these two perspectives. So when we're talking about the gap, and then what is the target? So for me, the target is, I believe, and the COVID gives us this reset, that every human being should have basic standard of living, right? This is my aspiration for humanity. So the idea would be, what would it take to take a person from extreme poverty to basic standard of living? And in that context, I feel the SDGs are a framework which define basic standard of living. So there's you must have this degree of nutrition, this degree of water, housing, some of our basic needs. So that, I believe, is the need. And out to any policy persons listening in, I'd like to quantify that amount. I want to know how much money is needed for a particular community, region, country to take people to basic standard of living. That's my ultimate sort of the demand. On the same side, the supply of capital, and we have this wonderful panel, and thank you so much for all of you to come into this panel. So as you know, Susanna, you had the OECD DAC, so it's the ODA, and the figure I had was 150 billion from last year. Would love to hear the figure, which is dedicated to development. And then we have Allianz and other colleagues. So it's the 400 trillion which exists in monetary value in the world, is how do we get that into development? So how does capital serve humanity and not the other way around? So just setting the context. And within that, as you know, CDF, UNCDF, we aspire hopefully to be the financing agency for the LDCs. It is our mandate from the UN, and it's the work we have been doing. So let me outline the work we do and then maybe the solutions I see. So we work into digital solutions. So we have our inclusive digital economies. So we try to fund fintechs, agri-techs, things that could make life easier beyond infrastructure. You know, we leapfrog a few steps and get people access to mobile payments. Then we do have our local development finance, in which we work with the municipal level. So I think in our strategic view, working closer to the people at the local level, municipal level, is something we bring to the table. I know other MDBs work perhaps more at the sovereign levels, so the loan sizes could be bigger, but we feel our niche has been on the sub-sovereign level. And then lastly, in the last few years, we've tried to put together now the instrument. We've been allowed for the last 40 years to do grants, TAs, loans, and guarantees. So this is very unique in the system, and that we've tried to do all of those. But we've also put together a blended fund now. So we have a blended fund for the LDCs. It's called the Build Fund. And there we are partnering with Bamboo Capital Partners. So we raise the first loss and they raise the mezzanine and commercial. So the point there is we want to raise 250 million for this fund. And you know, we'd like to have some first, second, and final closes soon. So the question, yes, and we've had this discussion in our former panel at the African Regional Review led by Malawi as well, that the comments I got back were the sizes of the deals are small and more first loss is needed. So, right, and so we decided, Susanna, that we would take this conversation forward. So the idea in this panel would be really to figure out how much first loss is needed and how do we increase the size of the projects, which is exactly what you were saying. So, so we have the Build Fund, and on the municipal side as well, we've partnered with a company called Meridium, which is a global infrastructure fund in Paris, to invest hopefully up to 350 million into the LDCs. On the Build, we have a special window for Malawi, and we've invested 6 to 8 million already, and the idea is to leverage around 35 million. So CDF, we play a role on the last mile. But we would like, you know, in our aspirations to serve the people of the LDCs to achieve those basic standard of living, that we get more capital into the countries. So in my view, I'm thinking of two solutions. One is we start pooling the projects. We kind of figure out, and we'll need all the capital structuring expertise of all the colleagues on this call and the wider financial markets system. So it can be pooled by sector. So can we do a pooling of all the solar energy projects, for example, in a region in Africa? That might make sense. Could we pool by country, a portfolio of projects per country? So then the investment is on a country risk and the pooling is managed, because that's, for me, the only way to substantiate the size of the projects. So we're thinking about that. We're working, we've launched within our team internal discussion to have country investment pipelines. And then there are parts that we can do at CDF, and then parts that other you know, persons on and across the financial spectrum can do. And the second one is then engaging with institutional capital, and we tried to do this in this panel. What will it take? Like, will it take more first loss? So then do you step in, Susanna, and then does that help Allianz, and does that get money to Malawi? So I think those two angles of pooling projects to make them more sizable, and then really honestly and openly and in an exciting way discussing what will it take between the concessional and non-concessional funding to make it happen. And we may be on our way there. We're not there yet. So that's why we would like to pull this panel and more panels like this in the future. So just to end by saying, going back to my first point, I would like capital markets to innovate as well, you know, in the risk perception. So that investment into human development, which I mentioned before, what will it take to take a person to basic standard? We are conceptualizing, it's very early days, but could there be some degree of a tokenization of investment into human development, some new instruments? So I hope, like, the COVID reset would also give us an opportunity to rethink the achievement of this basic standard or the SDGs. Thanks.
Thanks, Preeti. There's a huge amount there. I mean, this first loss question, I can hear a number of my my members around the you know, the DAC table sort of saying, I'm not sure that's what ODA is for. I mean, I think, to be honest, it comes back to this question of are we all rethinking our risk appetite? I think that has to be across the piece. I don't think it can just be, can the ODA mop up first law? I mean, I know you're not saying that, but I think everybody needs to think about their risk appetite. And I think this idea of pooling is really interesting. I mean, one thing I'm sure we'll come on to is what sectors we're investing in. And I hear what you're saying about, sort of basic, I mean, not basic human needs, I can't remember the term you used, but, I think often the focus is sort of more on job creation, on economic growth. And I mean, it's not, the least developed countries need both, but I guess for the private sector, they're not necessarily looking at that part of the spectrum, but I'm sure we'll hear more from them. And I mean, I think there's a perfect segue to Alan Atkisson. Nice to see you, Alan, who's the Assistant Director General for Innovation and Partnership at SIDA. Let me thank Sweden for its continued generosity for ODA. It remains an absolutely outstanding contributor of official development assistance. So thank you in the face of, a lot of domestic pressure as well. I mean, I think what would be great to hear from you is, what does this look like as a bilateral donor, a big and important bilateral donor? And what role do you think agencies like SIDA should be playing? How do you feel about mopping up the first loss? Or what else can we do? Can we do more with guarantees? Are there other things? You have the floor.
Thank you so much, Susanna. It's a pleasure to see you again, and a pleasure to see everybody around the table, old friends and new. And I can accept your thanks, Susanna, but only on behalf of the Swedish people who have elected a government that has that priority. So we at SIDA have the honor and privilege of implementing those policies, including our work in this particular space that we're talking about. We do two things basically when we're talking about trying to increase the flow of capital and just even the flow of interest, shall we say, and moving capital into the LDCs. The one is actually working with finance. We do blended finance. We do guarantees. We have a guarantee frame that's increased for us every year by the government. Right now it's 17 billion Swedish crowns. Our most recent study about what that money does in return, in terms of how one would respond to your members, Susanna, is that we calculate that for every 1 krona of ODA that goes into the actual cost of running our guarantee program, we get well over 70 crowns of mobilized capital. So we see this as a good investment, obviously, even though if we don't think about it in investment terms that way. We see it as a way of achieving our mission, that is to help address the needs of people living in poverty and oppression. So we do actual finance, but then we also work in partnership and trying to mobilize others to work in this space. And we brought together SIDA, a network, a coalition, an alliance, you might call it, of the largest pension funds and investors, asset managers in our country, working to educate themselves on the SDGs and then to mobilize actual capital, often on their own demand, going to, say, the World Bank to ask for the establishment of a new obligation or a bond that they could invest in, that sort of thing. And then that initiative led to a wonderful dialogue with UNDESA, and of course UNCDF is a major partner in this process to create global investors for sustainable development. Also with the aim of mobilizing engagement, mobilizing interest, but then very specifically helping to address the institutional barriers and perception barriers around risk, et cetera, that I think stand in the way. It's sort of a personal view, I have to confess, but I see that we're struggling here, taking your invitation, Susanna, to try to think a little outside of the box. We're struggling here with a kind of a perfect storm of conditions that have made it difficult for us to find that recipe for moving capital into the LDCs. And it's a perfect storm of risk perception. We at SIDA find that the actual risk when the day is done, after the guarantee has lived its life, was lower than what everybody expected it to be. Now that creates a kind of a tricky situation, because if it really is lower, then it's not concessional anymore, and we can't do it. But we discovered that we're doing our job of proving that perceived risk in certain market situations is lower than what the market is thinking it to be. So we have a problem of risk perception, and that's based partly on inadequate data. And we lacked good information about these markets, basically. And then the third aspect here is institutional gaps, and that's one of the things that we also work on, of course, in other parts of our ODA work, is helping to build the institutions that can help create more confidence, and of course create the information that's needed, as well as the changing the perception around risk. So we have some work to do there. We're, for example, right now, together with Convergence and GISD, working together to conduct a survey on how private actors might be more encouraged to engage with emerging markets and the LDCs. So trying to improve the information space is one of the things that we're working on. And trying to come up with, not just us, but in dialogue with our partners, come up with some of those concrete ideas. Can we balance in investments in the LDCs in a global portfolio in a balanced way? Can we do more with blended finance? So we're doing as much as we can, but can we mobilize other actors in that space? Can we stimulate with tax incentives? Can we develop relationships with the NDBs? We're with many people around this table and elsewhere, just trying to generate the concrete actions that might address that perfect storm that I was talking about earlier. So we need facts on the ground, more of them. We need better information. We need the will to invest, and we need to address that issue of risk perception that I believe could be a key to unlocking at least the start of greater will to move the capital into these markets. Needs to be combined with the actual on-ramps, the vehicles, the mechanisms. We're constantly in dialogue with other partners, both here and in other places, to explore what different kinds of instruments can be created so that the institutional investors will jump over that hump and begin to see the LDCs as a market that deserves a place in their portfolios. So I think I'll just stop there and note that we're very happy to be in this dialogue. We're always happy to be in this dialogue because while you talked about us, and we certainly feel very happy about the role that we play in the development cooperation world, we're not the largest at the table. So we like to help others with even larger resources get into the game as well.
Great, thank you. I mean, you're not the largest, but I think you are one of the most innovative. And the innovation matters. And look, I think your point about what you can leverage is so important. I mean, you're sort of 70 to 1, I think it was. I mean, we have a phrase we use a lot at the moment, which is how can we make the ODA that we do have work harder? And this is one of the ways that we can do it. I think your point about risk perception is also really important, that because some of these markets are not well known. So the default mode is, oh, they must be super risky. So there's a lot, I think, that can be done with better information sharing. And I mean, I suppose to say to the minister, the more that the institutions can provide predictability, the easier it makes it for investors. And I think your point, sort of hidden behind your point about pension funds, is there's some really good news about increasingly, investors looking for a social return as well. And that's new, and I think particularly younger investors. But the climate is changing in many DAC member countries, that people, they want it to be more ethical, and they're interested in these markets. So there's a job to be done to provide the information needed. And I mean, a little plug, but I hope it's a useful one. We have a huge peer learning community of practice at the OECD to do just that. So if anybody wants more information on that, we can we can send it through. I'm conscious of the time. Let me turn now to Kruskala Sierra-Escalante at IFC. I think congratulations are in order, Kruskala. You're acting director of the Blended Finance Department. I know you've got a new boss who was a former colleague of mine, a very, very good Brazilian dancer, I should say. We had the privilege of visiting him there, Maktar, when he was the country director in Brazil. So I'm sure he'll also be a great head of IFC. Why don't you tell us, what IFC is doing in the blended finance space, and what actions could be taken, to get this capital flowing? What's IFC's answer?
Thank you, Susanna, and many thanks. I mean, the acting roles are always, an interesting role to see with a lot of extra things.
Yeah, and you're always doing two jobs. So
exactly, and we are having an excellent time now, starting, to be led by Maktar. I mean, I didn't know that he was a good Brazilian dancer. I look forward to the opportunity to
my best.
I will, and I will be looking forward to seeing him in that. Having myself coming from Ecuador, I enjoy dancing, so it's a good, a good thing. So just to get started, and I think it has been such a wonderful and rich conversation up to now. I'll pick up a few points, and I think, as you mentioned, many definitions of what blended finance means, but within IFC and the DFIs, what we have been really trying to, to focus on is how we help to address participation constraints, how we crowd in others, and I think that's, the key. And you had a point that I think resonated very well with me, which is how do you take risk and perhaps, split it in smaller chunks so that people can, move forward and take some of that. So within some of the things that we do, in IFC, what we are trying also to see is how do we use different facilities to tackle different risks. And, through the IDA private sector window that, dedicates a lot of resources to, to the poorest countries, we have not only a blended finance facility, which can take, credit risk, but also a local currency facility that is dedicated to some of the challenges around, foreign exchange, which are, very significant. And then one that is dedicated more to risk mitigation in the infrastructural space. So at the end of the day, one of the beauties of blended finance, I think, is that flexibility across instruments. And what we are seeing is that, COVID-19 has just increased exponentially these real and perceived risks. So before, we were trying to already invest in SMEs and put some guarantees in place. We are seeing that it is becoming harder and harder because, private sector is concerned. And now what we have been trying to do with blended finance, initially it was the creation of markets. During COVID-19, we have to preserve the development gains that we have been able, to do. I mean, as you mentioned in your introductory remarks, we really have been, faced with such a, difficult challenge, for many, many countries. Risk sharing facilities, and I pick up with something, Alan was mentioning on guarantees. We believe it's a very effective tool for us to share risk. We use financial intermediaries. They keep, half of the risk. IFC for our own account will be taking another half of the risk. And then we use very effectively, blended finance, the donor funds, to back up some of that risk. And, that might be a 20%, a 30%, guarantee that is supporting. In the context of the risk sharing facility, I think that I wanted to tackle the point that you had on the first loss. And I think, it's a very challenging, discussion to have there. And probably we could have a whole panel on whether first loss is the right instrument or not. And in my mind, it's one of the instruments. And I think, we need to be creative in trying to see as to, in the same way that, donors and development partners might be taking a first level of risk, maybe we need to be thinking about how do you take also some sharing in the returns. And through equity, structures, we are seeing that we try to do some of that, in which, there might be, not only the risk sharing, but the return sharing. If the project or the facility or the aggregation model is, very well received, and perhaps the perception of risk was higher than the actual risk, maybe at the end of the program life, you can share, some of the returns. So this is something that, we need to, I think, all in a creative way, look at this. I just wanted to, also finally share a little bit of an example of, a recent facility that we just announced that is in the health area. And here we are using risk sharing facilities to work with banks to try to make, loans that related to medical equipment. So we call this facility the Africa Medical Equipment Facility, but in the context of COVID-19, we have seen, just a fantastic way to try to see how do you enhance, the procurement of, equipment that is related to, to health in that context. We have moved, Susanna, and it has been, a fantastic thing to see from the perspective of a practitioner of blended finance, how even within IFC, we have tilted towards using blended finance in the poorest countries. And I'll give you an example. When you look, from the years 2010 to 2017, about 40% of what we did was in IDA countries. You add the 3 years of the IDA, when we have had the access to the IDA private sector window, we are now at 66% of cumulative commitments in the IDA countries. And then I will, finish by saying also on the de-risking instruments. Before, a lot of blended finance was in simply concessional loans. That doesn't work in the least developed countries. You have to have the concessional loan plus the de-risking instruments. And we also have seen a movement during the same periods, basically to go to almost 80% of what we do cumulative in, non-loans. So it's the guarantees, the equity, and, as well as, some other de-risking instruments like local currency structures and, other things. So I'll stop there, but, a fantastic panel, and thank you to you and to the UNCDF for the opportunity.
No, thank you. And I think, Kruskala, your point about, we sort of wring our hands about how little blended finance is going into the poorest countries. But when we see how far we've moved in a relatively short period of time, and I think that, one thing, and I would encourage sort of colleagues to do this, there's a huge amount of lessons to learn from what has worked and what hasn't. I mean, we've got case law now that we simply didn't have 10 years ago. So I think that's very encouraging. And I think that's probably the perfect segue to Kurt Tan, who's the managing director of Artesian. So, Kurt, investment management firm, what would it take to really raise investments by a firm like yours in some of the poorest countries in the world, in some of these, very difficult markets, and even if they're not as difficult as people think, the perception certainly is that they are super, super risky. So you've got government, you've got the multilaterals, you've got bilaterals. What does it take, and how can we work together better? I think you're on mute.
Thank you. Well, good afternoon, and thank you for hosting this event. I'm absolutely thrilled to be here, and really appreciate learning from all the panelists here today. I suppose by way of a brief introduction about Artesian, we're an alternative asset manager that specializes in both fixed income and venture capital investing. And we've got offices across Australia and New York, London, Singapore, Shanghai, and Indonesia. So our fixed income platform is comprised of impact or ESG focused funds, while our venture capital business invests starting at the seed stage and onwards. And our VC platform actually has a history of ecosystem building. That's how we got started. So we partner with universities, accelerators, governments in building regional and thematic innovation hubs, especially in Australia, where we have a large presence. And this approach has the benefit of casting a wide net to capture deal flow for our investors, while at the same time directing investment in attention in sectors or areas of a country that might be desirable for a partner. An obvious benefit to a government partner is job creation to stimulate the local economy. So now when thinking about, I suppose, building a VC product tailored to the LDC or even elsewhere, one basic question we ask is, are the local participants who are committed to building and sustaining an innovation ecosystem? So that means, is there enough of a support system there that can produce a lot of investable companies? So we think about, research institutions that are center for intellectual property development and who can also produce a skilled workforce. And then when you combine that with, say a supportive government that encourages building out that ecosystem via supportive policies, whether it's capital treatment or grants to programs and entrepreneurs. So these are, just two ingredients that we find are needed to create successful innovation hubs. And then the next, we think about the investable universe. Is that big enough for an investor to dedicate the resources to commit for the long term? Now, it may be that in the past, large institutional investors find the local market size, in terms of the number of startups and the size of the markets that they're serving, to be either too small or maybe too early stage than their minimum requirements to justify, putting an allocation. So if you've got a good investable universe, we're now thinking, what's the exit potential in the local market to get back your principal plus return? Is the local, capital market deep enough to support an IPO, or, are we going to have to depend on trade sales as a primary assumption for returns? Or maybe we're just going to have to structure the vehicle a different way in terms of returning capital and profits over a longer term, more sustainable time frame. So, thinking about all of these issues, it might be that the traditional VC funds, which serve financially minded investors, right, that's investors who focus primarily on financial returns, might have just issues fundraising and investing on a standalone basis in the LDCs to justify the costs. But you've asked us to think kind of boldly. But what if I could suggest that we could attract a different type of investor? One who not only cares about financial returns, but strategic returns. So you might have national brands or even regional companies or multinational corporations who already sell their products or services into the LDC. And when you think about, the speed of technological change happening in the world, these companies have to care, they should care about monitoring the innovation and the startups behind these innovations that's happening in their local markets, because they could easily be beneficial or competitive threats, right? So think of a consumer beverage company as an example. What if there was a startup that's improving the distribution of consumer products in general in the LDC? And let's say the same market structure exists in other LDCs that the startup could easily serve. Now, all of a sudden, the startup starts looking valuable to this consumer beverage company, either as a partner, service provider, or potential acquisition target. So that's what I mean by strategic returns. And I think there's a strong rationale for a corporate to set up its own venture practice focusing on the LDCs. So I would suggest VC firms such as Atkisson, we could lend our expertise to these regional or national companies who need help developing a VC practice. And I think for a private manager such as us, there are a few advantages with this model. First, you don't need a large fund. You have one client, and they can be a path to exit or certainly growth capital for local startups. So in effect, you can help grow the venture ecosystem with relatively modest, financial commitments. So we can sidestep the minimum ticket size problem that the minister had alluded to for large institutional investors, and also, frankly, mitigate FX risk because you have a natural hedge because these companies are already selling products in local currency. So, I think thinking expansively about the different type of investors and their needs and working alongside local partners, we might be able to develop some products that could fit the LDCs. Thank you.
Yeah, it's really interesting. You definitely need a different mindset and a different approach. But it sounds to me as though that's the space you're thinking in. And I it must be possible. That's the way, I mean, it must be possible. You look at the size of these untapped markets, it must be possible to make a good investment and get a reasonable return on it. If you, as you say, you've got a local private sector, government is helping to create the investment climate. The skills issue is really interesting. And I think that's, something that I've worked on in the past, which is this worry, if you like, that on the one hand, this understandable international commitment to primary education, which is of course hugely important, but there's that skills gap. Are you actually educating the hundreds of millions of particularly, say, young Africans with the skills that they're going to need in the 21st century as opposed to the 20th? And I don't think we're doing enough on that. And I often wonder whether there aren't opportunities for collaboration, between bilateral donors and the private sector to get a virtuous circle going on relevant skills generation. And the cost of teaching good skills is falling all the time. I mean, we've all learned that this year. So thank you, really interesting ideas. Let me turn last but by no means least to Nadia Nkolova, who is the lead portfolio manager for development finance at Allianz Global Investors. Nadia, I mean, I feel like, I just want you to sort of come in and say what you think, but I guess the question is kind of the same. What stops Allianz? What do you need to go more boldly into LDCs? You have the floor.
Thank you, Susanna, and thank you very much for the invitation today. It's wonderful to be part of a panel with two of the partners which actually done blended finance with Citi and IFC. And I can talk a little bit about some of the partnerships we've created there. As an organization, as a team, we manage over 2 billion of commitments in blended finance. And this is at the moment the way we enter some of the least developed countries. I came with a set of notes that I've completely scrapped as I was listening to this panel, because I've heard so many exciting ideas. I absolutely love Kurt's idea. It's a very different way of thinking about it. Preeti, however, asked the question, there is 400 trillion of assets out there. And how do we attract those into the LDCs? Well, our parent company is a European insurance company, so I can talk about the insurance market, which is a substantial amount of that millions and trillions of assets. And if I look at the insurance market, the institutional market, 71% of the European insurance companies invest predominantly in debt, various types of fixed income and other types of debt. So I'll focus predominantly on how do we tap into that big pocket of capital. And then when I look at that 71%, 98% is investment grade. And this in itself explains the challenge that I think we all are facing at the moment. How are we going to get that huge amount of capital that is focused on investment grade to invest in markets that they hardly know, but also markets that are significantly below investment grade? There isn't a single LDC that is investment grade rated. Within the wider emerging market countries, we have 88% of non-investment grade countries. So there is something here around risk that we need to talk. Then we've talked about guarantees, we've talked about first loss structures. All of these are very, very helpful. They don't solve all the problems, but they certainly are very, very helpful. When I look at that group of investors again, and I start splitting their portfolios between types of securities they hold, the majority of the securities they hold are liquid securities. What does that mean? Securities they can trade in and out. Well, the majority of what we're trying to achieve, SMEs, infrastructure, renewable energy, are in the so-called alternatives bucket. A bucket that's been growing a lot over the past few years, but it's still relatively new. So it is it is really, when we're talking about investors that we can attract to the LDCs, we're really talking about the most sophisticated of investors that will have some non-investment grade, or will be able to structure a product that can reach the investment grade. We'll inevitably focus on that because that's the majority of the bucket, at least in the insurance market. And would be willing to take some sort of non-tradable risk. Because when I look at the LDCs, they are established capital markets. It is in certain countries, it is the case that we see the sovereign issuing public securities, quite often to their local markets. But the majority of the lenders to these countries are either MDBs, the World Bank, IMF, or their regional development banks. Few commercial institutions there is the likes of Standard Chartered, Credit Suisse, you name them, some of the commercial banks, but not really publicly tradable securities. So even if an investor wanted to go into those markets, again, the plumbing isn't in place. So we're having both problems. We're having a problem of risk. We need to get to investment grade, and we're having a problem of access, of having really the plumbing there. And then you layer on top currency, withholding tax considerations, regulatory restrictions, and so on and so on and so forth. And then I hear Alan and he says perceived risk is very different to actual risk. Well, institutional investors, when they're faced with that statement, they always say, show me the data. And this is another question that we can have. So I'm not trying to spoil the situation. I'm just saying these are some of the aspects. I think what we're trying to achieve here is we want to tap the fixed income or the debt bucket on the balance sheets. We want to get somehow to investment grade, whether that with the first loss, what we did with IFC, we co-invested with them in infrastructure market, in infrastructure sectors with a first loss from IFC and a backing from CEDA. So we want to get to that investment grade, and we want that plumbing. And that plumbing functionally exists. These are the MDBs. They have the track record, they have the people on the ground, they have the expertise. And that idea I really like, what Preeti mentioned, is that aggregation of assets. This is a very familiar concept that we have in developed countries. Several years ago, the UK rolled out the so-called public school aggregator project, whereby they didn't do individual schools one another. They aggregated them on a big level, and they financed top company. That reduces complexity substantially. I think one thing that we need to remember, institutional investors try not to be involved in complex products. Historically, they've done public equities and fixed income securities, liquid, tradable, things that they understand. I think the development community is used to complexity. They thrive on complexity. We need to somehow meet in the middle. Thank you for your time.
So look, you're so right. I mean, I'll be honest with you. I often feel like it's a completely different language and there's no simultaneous translation. We sort of go down our respective rabbit holes and stay there. And look, an awful lot of this is about better communication about how these markets work. I mean, I think very often, what diplomats spend their time doing is in a particular country, you'll get the development people and then the commercial people round usually a meal if it's in an embassy, and they have completely different information. You put that information together, it's actually quite helpful. But I mean, I've had so many conversations where I find it hard to believe we're talking about the same country or the same market. So it's not. I mean, of course, there is imperfect information, and of course, these markets are much less well known than familiar places, but they're not entirely unknown. So I mean, it's kind of, I think you're building on what Kurt said, which is, we need to just reframe this a little bit. So I'm going to sort of take the license of the moderator, and I'm going to have one more round. Really, I mean, I want to turn to Minister Kruskala Banda first. And say, I mean, what are you hearing? What is this? Does this make any sense, Minister? Are you excited? Is there any pushback? I want you to to ask the others for, clarification or how it feels if you're the person responsible for trying to make all this happen. And if you had one recommendation, what would it be? So it's a two-part question.
Well, thank you very much for that. And I hope by saying what I'm saying, I'm not opening a whole different kind of worms. For me, as a political player and also somebody who is working on the ground, I feel that some of the solutions that we're bringing to the table would cater for people who are already slightly well-to-do within their African countries. So you'll be talking about people who, like me, who have been to university and have jobs and we have our own farms and so on and so forth. But that's not where the real problem is. The real problem is right on the ground to the woman who has to walk 10 kilometers to draw water. How do we get that finance to that woman? Because if we are not careful, we will be funding people who are already well-to-do. And what that does is that whereas it might improve the growth, economic growth of a country, is it the right kind of growth? Because then it affects the growth poverty elasticity. I mean, you're going to be funding people who are already rich, and therefore you're increasing that inequality. What would be the solutions that would transcend this point and go down to the poor people? And so I was listening attentively, and most of the solutions that are coming out are going to be solutions that are going to work for people who are already mostly well-to-do. Now, of course, there are not too many well-to-do people in Africa, but they are there. And they're the ones who would understand all this. But the people that we need to assist are on the ground, and they don't understand all this. Now, where I'm trying to get with this is, are there solutions that would take that capital? I mean, I know it's going to make it very complicated, but how would we take that capital all the way down? And these are the solutions that I think we need to be crafting, so that we don't create a situation where we have few very rich Africans or people in LDCs and an extreme large number of people who have not benefited from these solutions. So that's what I'm hearing. I think that's the way I understood your question. Thank you.
Yeah, no, and look, it's a really, really good point. And I think we have all, sadly experienced, 2 to 3 decades of jobless growth, exclusive growth, these headline growth figures. And as you say, there's a small number of people who get richer and richer. So I think, it's a really good question to panelists. Clearly, it's something about employment creation. Clearly, it's an issue about which sectors you're working in. So and agriculture has got to be there somehow. Labor-intensive manufacturing, the policy climate, how redistributive are you being? I think, you mentioned sort of rural women access to credit. I think generally SMEs, and SMEs a lot are S, not M. They're very small. They've just got a handful of employees. They cannot get working capital. Nobody can run a business like that. So I think it's a very, very good challenge to everybody. So Preeti, do you have the answer? Once you've bundled everything, how do you then unbundle? I think that's what the minister's asking.
Well, I think what the minister said resonates with me. I will now have to make a plug for UNCDF, because actually we are the agency that is on the ground. We do the last mile investing. So my colleagues, the 300 of them listening, most of them are on the ground in the field. And we do these smaller size projects because they are linked to reaching the last mile, reaching that woman, reaching the local government. So I guess my plug would be, work with us, help us scale. And I think there's a lot of genius out there in the capital markets. I just feel it's a disconnect that the capital structuring is not connected with the human development, the development professionals. So, for example, we're trying to raise a $50 million on balance sheet facility called Bridge to do loans and guarantees. And I'm just saying, and the plug is do it through us, because we are actually targeting those kind of last mile SMEs, but we need to figure out who will give the UNCDF $50 million to on lend in loans and guarantees. So that's, I would just have to say it also in hearing all these amazing panelists and such ideas. So at least we are a player that accesses the last mile, but yes, we need to grow. So having said that, basically we use our grants and PAs to help build enterprises, right? So we would have, for example, women enterprises that we would build. So our bank told us we want to do a gender bond, but we don't know which enterprises the bond would invest in, right? So there is that work that needs to be done. But then our challenge is we want to scale, and how do we do that along with all the wonderful partners on the panel? And maybe just to leave, so my last sort of 2 points would be a bit of change on mindset in the capital markets. Again, going back to my theory of human development as an asset class, right? When the minister is saying it has to be the person, on that last mile. Therefore, using COVID or all these horrible impacts that we've had, can we make money think differently? And one way would be, as I was mentioning, attaching a value to the fact that humans have a basic standard of living. And I'm now bringing in a bit of the token, the blockchain. It's something, we'll have to think innovatively, but there should be a value in the investment for capital, private, and then there should be a return in it. The return means turning something very intangible, like providing basic standard, to a tangibility. So a little bit reflecting on social impact bonds, the returns-based aspect of achieving a result for the world. I mean, we have to think differently, right? So the one that has happened in the markets has been a rhino bond on preserving the number of rhinos. So that's preserving biodiversity. But could we have a bond or something that gets money, to these last miles? So everybody gets, it's about eliminating that extreme poverty, just building that basic infrastructure, whatever it would take. And it could be different types of bonds. So somebody could focus on jobs, etc. So that would be my kind of other plug, to be a little bit innovative and think differently. And I don't know if you'll have it last chance, but basically I'd like this discussion of having the country, the concessional money and the non-concessional money on the table. I think if we do a few rounds of these, we'll get that interaction that we need. Thanks.
Yeah. No, thank you. Thank you very much. I mean, can I put in a pitch for the penultimate mile? Because I think what we often, we, as the minister rightfully said, that, there's a huge amount of wealth in Africa. It's quite concentrated, and a large number of very poor people. But there are a lot of interventions, particularly where I think blended finance should be focusing, which is that middle, emerging category of people who are not the absolute poorest, but they can save a little bit. A bit of investment can go a long way. And if one looks at some of the success stories in Asia, it was that category of people that really reduced poverty in a sustainable way. Alan, how can CEDA help with all of this?
It's so interesting to listen to all the other panelists. I must say I'm learning quite a lot from this dialogue. And we're as a development agency, we're not a financial agency. So we act in this space, but we have different goals, and it's interesting to listen to the other actors like Nadia and Kurt from the institutions they're coming from. How do we meet? Where do our interests meet? Nadia took up the issue of risk again and noted that where's the information? That was also my point. We're lacking information, and that information is needed to create the kinds of innovative structures that Kurt was talking about. Kurt, I'd love to learn more about what you're thinking. I think I understood about half of it, to be perfectly honest. And that's one of the issues here. We speak in the development world a language that only overlaps with the language of the financial world, and we have to work a little bit harder on that. But I also, because we're development agents, we move in many different worlds. So for example, last week I was moderating a conversation like this with about 30 governors of central banks around the world. And there I was learning a tremendous amount about what's happening in for example, the rapid spread of new kinds of payment services, digital services, and those are of course generating data, and they're generating data about the credit worthiness of the people in those markets at a small scale, but aggregated, it becomes quite a huge signal. That isn't really, that gap has not been closed, I would say. That the rapid generation of new information about new economic actors in markets and what the potential is in those markets, there's a long way to go until we get to the point where we can get to the kind of scale that Nadia is talking about. But I'll tell you what we're doing at SIDA. We of course are very happy to see both Allianz and IFC here, partners in guaranteeing and first lossing and moving capital. And that's a wonderful initiative. We're very happy and proud about our engagement with you there. We spend probably an equal amount of time working on proof of concept, small initiatives. For example, a guarantee through intermediaries that mobilizes capital into long-term refugee camps in Uganda, moving capital to mobilize the potential for small business development. It's pretty unique as far as we know in an actual refugee camp context, but it's nowhere near the scale of what Nadia is describing we need to get to. So closing that gap is essential. And it needs to be worked at from both ways. We would like to see, to make my pitch, from SIDA, we would like to see more and more actors in the concessional finance space using guarantees to do the proof of concept, to scale up, to approach something more like critical mass in terms of the data that can prove the possibilities, so that the wiser heads around actually crafting aggregated instruments can come to the table, and Preeti's colleagues, for example, or Kurt's colleagues, through coming from different directions, and create those new instruments that can approach that scale and approach investment grade, to use Nadia's important concept.
Yep.
I'll stop there.
Great. No, well, look, thank you. And I think your point about language is so important. And we're not very good at this. We're not very good at joining up the dots. We need to get better. Kruskala, how can IFC help us do that?
Thank you. I'll start with a couple of points to how to get to the smaller, the biggest need and the smaller entities. And for us, partnerships with, the local financial institutions are essential. I mean, we may not be able to get there, but they are going to get to their clients, which are these local, SMEs. And I could not agree with you more, Susanna, that it is really in these SMEs that we see job creation. I mean, that's where they are going to be, creating their business and trying to then ignite the economy in a way that, bigger institutions may not be able to, to do. I think the other point that I would like to make, and I'll pick up from the earlier intervention that Preeti had, is about the ability to have projects. Because sometimes we're talking about right now the financing, but sometimes there is no projects. And I think, it's in the lack of those projects that we have, as IFC, been investing a lot of time and effort. And, we call the whole approach our upstream work, to try to really engage at the very early stage to see what is that we can do. Feasibility studies, project preparation, to try to create, projects. We have put 270 new people, to focus just on this, project preparation and creation. And this is not only going to be projects for IFC, it's really for the whole ecosystem to then to be able to, to get financing to projects across the globe. I will say a final point that I will make, noting that, we are close of time, is that we really need to remember that blended finance, it's a wonderful tool, it's one of the tools. So there is still the policy reform, the technical assistance, to be able to, to support others. And also blended finance, because we're using concessionality, could be also, misused if we don't think about doing it in the right way. So the utilization of the DFI principles, when we apply blended finance, makes a lot of sense. When, the development partners are giving blended finance, thinking about the OECD principles of blended finance. And, we have really worked, very closely together to the OECD to make sure that these two sets of principles speak to each other, just to make sure that we are creating markets, not distorting them, because it's just too precious, these public funds to misuse them. So thank you very much, Susanna.
No, thank you. And thank you for plugging the OECD DAX blended finance principles, which I work very closely with your colleagues on making sure that these were singing off the same hymn sheet. But you're right. I mean, blended finance, it's not the answer to everything. A lot of people are very skeptical about it. But as I said earlier, we are building up, I think, some case law about what works and what doesn't. Kurt, you've sparked a lot of interest. I think people are going to want to know whether you've written this down anywhere or if we can have a follow-up conversation. But what would you like to do next to take forward your ideas?
Well, I'd like to maybe give a spark of hope to Minister Kachala Banda, because our experience in Australia, we've been investing on the VC side for over a decade. And looking back 10 years ago, the technology innovation startup scene there was pretty nascent. It wasn't an institutionally investable asset class that it is today. And it took a lot of grassroots efforts, a lot of government support, certainly business support, and a lot of other players. And having each of these grassroots efforts build a hub, an innovation hub across the country. It doesn't have to be national at first. It could be starting at the city level, but have them all connect to each other so that there's a lot of information sharing, best practices are shared, it's decentralized. It's, after 10 years, we are where we are now, and there are numerous institutionally sized funds investing in VC in Australia. So that's been the path there. And I would suggest, we continue to build the ecosystem, the entrepreneur ecosystem in the LDCs, because if you can build the opportunity set, the investable opportunity set, then I think that asset class, we can actually call it an asset class maybe 10 years from now. And so the financing will flow that way. And certainly private funds such as us, who won't have the footprint, the physical footprint in the LDCs, will be strongly reliant on partners such as UNCDF and others who have the infrastructure and the experience with identifying, underwriting, mentoring, providing technical expertise to these startups, so that private fund vehicles could invest alongside, whether above a loss piece or not, but then that would effectively reduce the transaction cost and create some funds that doesn't need to be very large to begin with. So I think that's probably where I would suggest one way to approach it. And I'm certainly very, very excited to be in this panel, because I've learned a lot of new things, such as the OECD's peer learning practice. I mean, that's something that could be of great interest to my firm.
Great. We'll join you up, and I say let's keep this conversation going. So Nadia, last but not least, what are your final thoughts? And then I'm going to open it up to a couple of questions before we close. Nadia.
I like the idea of ending up on a hope note. I think European legislation is definitely pushing more and more institutional investors towards sustainable investments. And of course, the argument that $1 invested in Malawi in renewable energy has a much broader implications economically than doing so in Germany. where a lot of the capital historically has been. So I think there is positive shifts in that direction. We have already created and we are scaling up blended finance vehicles. We've worked on several over $1 billion funds that are hopefully going to invest. And the plumbing, of course, comes with partnerships. It comes with the partnerships that we have with multilateral development banks. And hopefully things like the GEMS database are going to come out and they're going to crowd in even more institutional capital into these markets. I think several things, diversification is very important. So I think the portfolio approach to blending is absolutely key for what we see. And that actually could very much go to that one last person. It's just that I think that we are going to have to be several layers behind. You would have the institutional capital, you'll have the MDBs that are going to be investing in the microfinance organizations that are going to be investing in hopefully the S's rather than the M's and would reach that last person. But it requires that whole chain of people speaking the same language, something we touched on. One of the biggest challenges that I face today around is the raising of that first loss. A lot of the donor capital is specialized on certain regions, certain sectors, and there is an idea that private capital mobilization isn't on its own a target. This is the reason why we see such small blended funds. Most funds are 200, 300 million. They don't make a difference because the upfront cost of creating these vehicles is absolutely humongous. So what we need to scale those vehicles is to start thinking that private capital mobilization on its own should be a target, because otherwise we end up with small vehicles. So I'm hoping that with the people around the table having more conversations, we're going to reach that last mile. There wouldn't be the direct access, but I think one layer after the other would reach that last person.
Great, thank you. Well, look, as you're absolutely right, Nadia. It's good to lift our spirits and to think about being positive. We've just got 10 minutes left. I'm just going to take 3 questions. There are a lot of questions in the chat and as in the Q&A rather. And as ever, it's very, very difficult to do them justice. But I know that Sarah Offermans, who's the head of Human Rights Humanitarian Development Department at the Dutch Permanent Mission to the United Nations, has a question. After that, I will give the floor. I don't know, are you Herschel Daniels or Daniel Herschels? Not sure which way your name works. And lastly, Dosa Sosonga. Can I say to all 3 of you, please, the shorter your question, the more time our panelists will have to answer. If you go on and on, I will cut you off. And please say who you're addressing your question to. And please make it a question, not a soliloquy. Let me start with Sarah, please.
Sure, thank you. Thank you very much, Susanna. Can you hear me? Yes, that's great. Thank you, and thanks for having us listen into this really rich and important discussion. Alan, I was very pleased to hear you say some of it was lost in translation to you as well. It is true, I think, that we speak different languages and that's a problem. So I hope many colleagues of mine are listening into this discussion. I was going to make a bit of an introduction about the Netherlands' position on all these issues, but I'm not going to do that with a view to the time. I just wanted to interject one element into the discussion that we haven't heard that much about, which is the gender aspect. And from the Netherlands policy perspective, we're really focusing on empowering women entrepreneurs because we feel that that is untapped potential that can help us take a number of boxes in terms of the objectives we've set, both in supporting existing jobs, creating new jobs, but also putting innovations into practice. So I have 2 questions, one to UNCDF. And I wanted to really commend you and also the OECD on your report on blended finance in the LDCs. It's really helpful to show us how we can do better. And I was wondering, can you share something about how UNCDF would like to create more opportunities for women in LDC economies? And also what your recommendations would be to governments of LDCs in terms of changing their policies. And then maybe to IFC, We've seen that currently the available donor funding is too limited and spread too thinly to support all multilateral banks to adapt their policies. So how is IFC adapting your investment policies and practices to better reach female entrepreneurs and LDCs? I will leave it at that. Thank you very much.
Thank you very much. I'm going to take all the questions. I think, to be fair to the minister, he did say very clearly what Malawi had been doing to try and get resources to women, but as ever, we never ever pay enough attention to gender. So let me, quick question please, from, is it Herschel or Daniels?
It's Herschel Daniels.
Herschel Daniels, okay. Herschel,
yeah. So,
fire away.
Thank you. From the US perspective, from last week on the permanent forum on people of African descent, the US has instituted under the Biden presidency an executive order to address inequality. In the UN, what about quantitative easing and the creation under the Addis Ababa Action Agenda and creating a public-private partnership with an SPV with Alanes and other insurance companies? This SPV would basically be a $30 trillion quantitative easing instrument over a 75-year period. Would study that issue. It's being brought up in the permanent forum on people of African descent.
Okay, thank you very much. I mean, if you've got anything you can send on that, I mean,
it's in the working group of experts on people of African descent on December 3rd, and it was outlined on April 9th in the permanent forum on people of African descent, and will be submitted on May 11th, and when the General Assembly, Chad and Costa Rica are the co-facilitators.
Okay, thank you for the heads up on that. It sounds really interesting. I mean, I would say, we collectively as an international system have not stepped up and met our commitments that we made in Addis Ababa in 2015.
Well, we were there. We actually were the only Black American group that was invited, and we've been involved in the UN 52 years. And so, again, the United States set up a fund of $580 million for multilateral.
Thanks, Herschel. I do want to get one more question in, but a really good point to raise. Thank you. Let me turn to Dose, please. Sosuga, you have the floor. I think you're muted. Dose, are you there? Are we getting? I'm sorry, Dose, we can't hear you.
Please, I have a noise here. It's not good to do.
Okay. Well, thank you for trying, and I hope you enjoyed the discussion. Thank you. Okay, so look, just quick. I'm just going to ask Preeti to respond on that question, and Kruskala, just literally 30 seconds, please, and then I will try my best to wrap this up.
Sure. So Sarah, just an outline, what we do at CDF, as I said, 3 vertical pillars: digital inclusion, infrastructure and climate, and then innovative blended finance. But across all 3, we have cross-cutting gender and climate, and we're thinking of biodiversity. So for us, in answer to your question, we have a significant number of activities we would like to talk to you, but Examples on entrepreneurship is working in Papua New Guinea with, bank to make a mama bank, things accessible to women, the ATMs or the touch points where they can access finance so that women have more access to finance. So a number of projects like that, working with Bangladesh or other countries to get their national policies on financial inclusion to have the women factor in there. So we're really working for us, we have 2 gender focal points and Laura, who organized this panel, as a gender focal point, Amina as well, in infrastructure and in digital. So we'll come back to you with a comprehensive note if that might be.
Great. Thank you. And Kruskala, let me give you the last word.
Thank you very much. And I will be very quick on this. So the first thing, investment targets, that becomes very, very important and relevant. And as part of our capital increase, we made commitments on increasing our investment with a gender focus. We use blended finance, and we use it in a very efficient way through the performance-based incentives. We have dedicated facilities for gender finance, and also many of our facilities that come with bilateral partners and multilateral partners request co-benefits around gender. So in addition, we also have gender focal points. There is a unit that we have on gender and economic inclusion, and we try to not only incentivize and teach our own investment colleagues how to think about gender, but also our clients how to think about gender aspects in their own projects.
Thank you very much indeed. So look, we are out of time. And I'm sure everybody's had a long day. Certainly those of us who are to the east rather of the eastern United States. It's getting dark. So look, this has been really interesting, and I'll be honest, not all panels are interesting, right? So thank you to UNCDF for bringing together such a useful and dynamic set of panelists. I think we've had a really good mix, having the view from government, from the minister, the view from the private sector, from Kurt and Nadia, the donor view from Alan, and then the multilaterals, Kruskala, Preeti, trying to pull all this together. I mean, I think my plea, first of all, is, can we talk to each other more in words of one syllable? We don't have to overcomplicate what we do. We're all experts in our respective fields, and the sign of a real expert is to be able to explain it to somebody who isn't. So the first thing I would just, like us all to commit to communicate in language that's well understood. I mean, the second thing that's really clear to me is, look, there's plenty of capital out there, right? We're not short of this stuff. It's just how do we crowd it into these unfamiliar, highly risky, difficult markets, and particularly to reach not the elites. I think the point the minister made was so important there, but to reach women, to reach those who can set up small businesses that are going to generate jobs for the young people in least developed countries. And how do we build up local financial institutions, local markets, local capacity, local skills? So we don't have a lot of answers, but I do think I'm very struck by the energy and innovation. So thank you for that. And Preeti, please find a way of continuing this conversation. I did ask, I'm not very good at multitasking, so I wasn't able to paste our development, the OECD blended finance principles and the community of practice into the chat. But if not, I will get my office to send it round to everybody afterwards. So look, enjoy, thank you. And let's keep this conversation going, because it must be one of the most important elements of building forward better and greener. We will not do it unless we have the least developed countries at the center of our objectives. Thank you, and enjoy the rest of your day. Preeti, I don't know if you want to say anything in closing.
I just wanted to say, Susanna, that you're the most brilliant moderator. Yes, and I think
you're very kind. You're a lot easier than the DAC. There's fewer of you.
the panel would agree. We've been texting, and thank you to all the brilliant panelists as well. And I really hope we can continue this conversation. So we'll try from our side to reconvene. And thank you so much.
Thank you, and thank you to our interpreters as ever, and Laura and Casper. Have a good afternoon, evening. Bye.
Thank you
everyone.
very much. A pleasure. Thank you very much.
Thank you, Minister. Bye.